Hello and welcome back to this channel. A simple guide to chart pattern trading strategy. Chart patterns are an integral aspect of technical analysis, and it is helping traders where the price might go next based on what they have done in the past. It is going to form between 10 to 50 candles and can give us an indication of a possible price reversal. Chart patterns generally fall broadly into three categories. The first one is continuation chart pattern. The second one is reversal chart pattern. And finally, the last one is bilateral chart pattern. Chart pattern by far my favorite ways to enter the trade. And although there are hundreds of them out there that explain all of them is beyond the time limit of this video, but some of my favorite chart patterns that I use in my own personal trading are as follow. The first one is double top and double bottom chart pattern. The second one is horizontal and inverted head and shoulder chart pattern. The third one is ascending head and shoulder chart pattern. And finally, the last one is bullish and bearish flag chart pattern that I'm going to explain all of them in detail in this video. So please stay tuned to the end of this video.
Chart patterns can generally fall into three categories. The first one is continuation chart pattern that shows the price trend will continue once the pattern has finished. They are seen as a pause in the market direction, such as a period of price consolidation or build-up before the trend resume and continue its course. They can also be seen as both uptrend and downtrend continuation pattern. The second one is reversal chart pattern. It refers to as chart pattern that tell you the ongoing trend is about to lose its momentum and changes its direction. If this reversal occurred during an uptrend, it suggests the buyer's power are coming to end and the sellers overcome and push the price lower, and vice versa for downtrend. And finally, the third one is bilateral chart pattern. It refers to those uncertain chart pattern that is difficult to predict where the price might go next, up or down, after the pattern has been formed. Symmetrical triangle is one of the bilateral chart pattern. In this type of chart pattern, it is advisable to use other market analysis tools to avoid losses and secure your asset. The first thing I'm going to talk about how double top chart pattern is formed. In a trending market, the price always making higher swing high and the pullback is making high swing low all the way up. Here we have our first top one located on this strong resistance level. If the uptrend want to continue, then the price should make another higher swing high, higher than the previous one. The price rallies going up to make another higher swing high, higher than the previous one where top one is located, but it failed to go higher and instead it retests this resistance level and bounce back. As a result, top two and the neckline is formed. The price then come down toward the neckline, break the neckline, and continue going downward all the way. This is how double top chart pattern is formed. To enter the trade, it's so easy. The first method is you wait for the price to break the neckline and close below the neckline, and then you can enter the trade at the close price of that candle and put 2 ATR above the close price of that candle for the stop loss and put 4 ATR below the close price of that candle for profit target. Or The second method is you can wait for the price to retest the neckline and bounce back down, and you can enter the trade around this area. Same method as the first one. So in the first method, you are going to have 2-to-1 reward risk ratio, and this is how you can trade the double top chart pattern. Now let's see a real example how to trade double top chart pattern. How to trade the double top chart pattern. This is the price trend, WCP stock D1 time frame Yahoo Finance. In this graph, the double top occur when the market is going up and hit a strong level of resistance that cannot be broken. Then the price got rejected and pushed down slightly toward a level of support, and the first top one is formed. The price bounced off the support to retest this level of resistance one more time. Since the price cannot break this strong resistance level, it goes down toward the support level. Then the price break the support and continue going downward all the way and producing top two and the neckline. Now to enter the trade, it's so easy. You can wait for this bearish candle to close below the neckline, and then you can put your entry to ATR above the close price of this bearish candle for stop loss, and for ATR below the close price of this bearish candle for profit target. So this is going to be your stop loss, and this is your profit target. So this is how you trade double top chart pattern. How to trade double bottom chart pattern. This is the price trend crude oil stock D1 time frame Yahoo Finance. In this graph, the double bottom occur when the market is going downward and hit a certain level of support that cannot be broken, then pushes up slightly toward a level of resistance and producing the first bottom one. The price can bounce back to retest this level of support one more time. Since the price cannot break the support level, it rallies going up, breaking the resistance level, and continue going upward all the way up and producing bottom two and the neckline. Now we can place our entry at the first bullish candle that closes above this resistance level or above the neckline, and we put our stop loss to ATR below the close price of this candle as a stop loss, and we put 4 ATR above the close price of this bullish candle for profit target. So this is our stop loss and this is our profit target. That's how we can trade double bottom chart pattern. The second thing I'm going to talk about is how horizontal head and shoulder chart pattern is formed. I'm going to explain how head and shoulder is formed using demo graph first, and then I apply it to the real chart. In this graph, the price is making higher swing high and the pullback is making higher swing low all the way to the top. The left shoulder is formed and the head is also formed, especially when the last pullback declined to a point at or near the previous higher swing low. If the uptrend wants to continue, the price should make another higher swing high, higher than the head, but this time it failed to reach that high and close below the head, and the right shoulder is formed. Now you can draw the neckline by connecting these two higher swing lows or the two throws exactly like this. Next, the price drop down lower, break down the neckline, and three scenarios might happen. The first scenario is the price break down the neckline and without retesting the neckline, it continue going lower all the way. The second scenario is the price retest the neckline and then continue going down all the way. And finally, the last scenario, the price before breaking the neckline, it consolidate or build up for a while and then break the neckline and continue going lower, the opposite direction of the original trend. Let's see a real example, and I'm going to show you how you enter the trade and set your stop loss and your profit target. How to trade horizontal head and shoulder reversal pattern. This is the price trend BGR stock D1 time frame Yahoo Finance. You see the price is trending higher and making higher swing high, and the pullback is making higher swing low all the way up. And as a result, the left shoulder and the head is formed. And look at this trend. This is higher high, which is higher than the previous one. And this is higher low, which is higher than the previous one. That is the characteristics of an uptrend. Now, if this uptrend wants to continue going higher, now from here, this higher low, it should go up and close above the head. Look what happened. The trend went up and closed below this head, and instead of higher high, you make lower high here, and as a result, we have the right shoulder. Now, in order to draw our neckline, we have to connect these two truths or these two higher lows in order to make the neckline, just like this. Now look what happened after. After, the trend is continue going lower and breaking the neckline and continue going downward all the way. So now how we can enter the trade? To enter the trade, look at this bearish candle that break the neckline and close below the neckline. So we use this close price of this bearish candle and we put our stop loss 280R above the entry price for a stop loss, and we put 480R below this entry for profit target. So this way you are going to have 2-to-1 reward risk ratio. You can also put 180R above the high for a stop loss and 280R below the low of this candle for profit target. So if you use the first method, then you are going to have this for stop loss and this for profit target. This is how you can trade horizontal head and shoulder reversal pattern. Next, I'm going to show you how ascending head and shoulder reversal pattern is formed. Ascending head and shoulder is a strong chart pattern that you can see it all the time. Whenever you see a strong trending market, it will eventually reverse, and you may see this pattern more often. And that is the reason I'm going to show you how does it work and how to enter the trade and set your stop loss and profit target. In this graph, whenever the price is trending higher, the price is making higher swing high, and the pullback is making higher swing low all the way to the top. As a result, the left shoulder and the head is formed. If the uptrend want to continue, the price should make another higher swing high, higher than the head. But this time the price failed to reach that high and close below the head and form the right shoulder right here. Now, it is easy to draw the neckline by connecting the two truths or by connecting the two higher lows to make the neckline right here. Next, the price drop down lower, break down the neckline, and continue going lower. Sometimes the price break the neckline and then retest the neckline and after continue going lower. Next, I'm going to show you a real example using ascending head and shoulder to clarify the trading strategy. How to trade ascending head and shoulder chart pattern. As I explained earlier, whenever you see a strong uptrend where the trend want to reverse, you normally see this ascending head and shoulder. So please pay attention to when and where to enter the trade and make profit. This is the price trend, lowest corporation D1 time frame. In this graph, the price is trending strongly upward, making higher swing high, and the pullback is making higher swing low all the way up. And as a result, the left shoulder and the head is formed. So here you see this higher swing high is higher than the previous one. This is higher than the previous one. And this higher swing low is higher than the previous one. And this higher swing low is higher than previous one. That is the characteristic of a strong uptrend. Now, if this uptrend want to continue higher, the price should go higher than this previous high swing high, or the head go all the way up and return here, or close here and return. Now look what happened. Unfortunately, the price failed to reach that high, which is a strong sign of a price reversal, and closed below the head, and as a result, the right shoulder is formed. Now it's easy to draw the neckline by connecting these two higher swing low, and the neckline is going to be look like this. Now after that, the price is coming down or going downward, breaking the neckline and going all the way down. So in order to trade or to enter the trade, look at this bearish, strong bearish shooting star that closed below this neckline. So you can enter the trade at the close price of this shooting star, and the information of this shooting star is right here, and this is the ATR value for that shooting star, and put 2 ATR above the close price of the shooting star for stop loss, and 4 ATR below this, the close price of this shooting star as a profit target. So The stop loss is going to be like this, and this is going to be the profit target. So this is basically how you trade ascending head and shoulder chart pattern. How to trade inverse head and shoulder chart pattern. Inverse head and shoulder is basically work the same concept as ascending head and shoulder. In this graph, the price is making lower swing low and the pullback is making lower swing high all the way down. As a result, the left shoulder and the head is formed. If this downtrend want to continue, the price should make another lower swing low, lower than the previous one, or lower than the head. But this time, as you see, the price failed to reach that low and close above the head. As a result, the right shoulder is formed. And this is the sign of reversal. The neckline can be drawn by connecting the two lower highs together, just like this. After the price go up, break the neckline and continue going upward to enter the trade, we see this bullish candle that penetrate inside the neckline and break the neckline and close above the neckline, so we can enter the trade at the close price of this bullish candle and put 2 ATR below the close price for stop loss, and we put 4 ATR above the close price of this bullish candle for profit target. And this is going to be the stop loss, and that is going to be the profit target. So that is how we can trade the inverse head and shoulder chart pattern. What is a flag chart pattern? A flag pattern is a formation that starts with a strong move, big body candle, represent the flagpole, followed by a weak consolidation move, small body candles represented by a rectangular shape called the flag body. Flag pattern consists of between 5 to 20 candles, and it occurs when a strong trending market have a short period of consolidation to regain its power for a strong takeoff to move higher or lower. In an uptrend, this is a sign of continuation pattern, which indicates the buying pressure and momentum is strong to push the price higher than lower. It means the trend will resume to its original direction after breakout. This is also allow traders to enter the trade in the middle of the trend, buying a stock at a lower price. Bullish flag pattern is among the most reliable and effective pattern for short-term investment, and the best time to trade this pattern is after a strong breakout. How to trade bullish flag chart pattern? This is the price trend Euro British Pound stock H1 time frame. Here you see 3 flag pattern, and this is the one that I'm going to enter the trade and show you how to enter the trade. You see the price is in consolidation and the size of the candles are very small, and you see this resistance level, and this bullish candle break out of this resistance level and close outside, and this is the information for this bullish candle. That is the ATR value. So there are two methods that I can enter the trade. The first one is I use 280R below the close price for stop loss and 480R above the close price for profit target. This way you get 2-to-1 reward risk ratio. And the second one is you put 180R below the low of this bullish candle for stop loss and 280R above the high of this bullish candle for profit target. So if I use the first method, this is going to be my stop loss and this is my profit target. So this is how to trade bullish flag chart pattern. How to trade bearish flag chart pattern. This is the price trend Canadian versus Japanese yen H1 time frame. As you see, we have 3 bearish flag chart pattern, and this is the one that I'm going to use to enter the trade. You see the price is in consolidation, and the size of the candles, the body of the candles are very tiny. There is not that much fluctuation, and as you see, as the consolidation or the flag pattern completed, you see the price is ready to break out of the support. You see this bearish candle that it opened outside the support area and going down. This is the information for this candle, and this is the ATR value for this candle. And I'm going to use the open price of this candle to put my stop loss. 280R above the open price of this candle, I use it for the stop loss, and 480R below the open price of this candle, I use it for profit target. So this is going to be my stop loss and this is going to be my profit target. You can also use 180R above the high of this candle for stop loss and 280R below the low of this candle for profit target. So whatever method you're using, your stop loss should not be too tight in order to that it kick you out of the trade, because there is not enough room to breathe. And your stop loss should not be too wide that you get a poor reward risk ratio. So this is basically how to trade bearish flag chart pattern. I hope you enjoyed this video. I wish all of you good luck and a good trade. And please don't forget to smash this subscriber button.
That's all, folks. If you like this video, thumbs up and subscribe. Thanks for watching. Take care and see you next time.